Every business aspires global expansion. Some have abundant capital, but not a right project to invest, and somewhere a promising startup is struggling without the cash. Just like a seed needs sufficient water and light to nurture, a great idea needs professional guidance, capital, and training to grow. We at businessx.com provide a unique platform for businesses and startups to connect with individual investors, corporate investment firms, lenders, venture capital firms, private equity firms, mentors, incubators, brokers. We help you to make a connections and clinch the deal of your dream. Think of us as a business network which nurtures partnership. businessx.com.
Hi everyone, this is Sonali. Thank you all for having out some time for attending today's webinar on the part 3 of the BEx Learning Series, all about finding the right value in a business. To all the attendees out there, please type in any questions you might have in the Q&A section, and we'll try to answer as many as possible at the end of the session. Request you to keep the questions within the scope of today's discussion and not to your personal business queries. I would now like to welcome our speaker, Mr. Gaurav Marya, Chairman and Founder of the Franchise India Group. A very warm welcome to you, sir.
Thank you, Sonali. Thank you very much, Sonali, for inviting me again for another series and organizing this regular webinar. This is the third in the series. We have divided every week to take up one topic. The first topic we took up was how to invest. Then the last week was how to scale. And today's is how you value your business. And today's webinar, we'll talk about why you should value your business, how you should value your business, and when you should value your business. That's very important that we go through this whole cycle. This webinar is now, and that's my apologies also for the little delay in terms of starting, because this is in 3 platforms running. It is running on our Facebook Live. It is also on Zoom, and it is also been real-time telecasted on our exhibition, first digital exhibition which Franchise India is hosting today, which is attended by over 4,000 odd people. It's also been telecasted there. So the integration of technologies and also everybody working remotely sometimes causes a lot of delays. So sorry for that. So let's start with the valuation part of it and why it is so important, and especially now, and these times where everything has changed. The way we looked at businesses before March are very differently way we're looking at businesses now. The promoters who were very involved and committed to their businesses would have changed by now. So a lot of people who were not looking to exit the business might like to exit the business now. And some people would see this as an opportunity to acquire a lot of businesses. So a lot of things would change which has already changed as a mindset, I call it, in last 3 months. And this would start changing significantly over next 2 quarters. And we will see the large amount of M&As coming in 2021. And especially we have never seen this happening at the entry and the mid level. And I see a huge opportunity coming at the entry and the mid level, both in terms of the consolidation, a lot of M&A, a lot of equity participation, and so on and so forth. I also feel there is a big worry that a lot of businesses would exit without having any value. And that's very painful to me, because I feel that every business, whatever it is and whatever stage it is, it has some inherent value. And sometimes business owners are so busy in their own businesses and in their work, they have never had time to value your business. Now, I ask this question to every business owner, that you know the value of everything you possess. You know the value of your house, you know the value of the jewelry you have, the investments you've done in financial world, the properties you own, even the watch you wear, you know the value. But the business which you run for years and years and years together, and every day you put in 12 hours or 14 hours of business, you don't know the value. And I'll tell you why you don't know the value. And that's why in India, only 1% of business or less have been valued. So fundamentally, and these are also companies either listed, because listed, you have a market capitalization, so you know what the market cap available with you, or the companies which have unlocked their equity. which means that they have invested, they've got an investor coming in the business, and at a certain stage, they have got the valuation of the companies. And startups normally have done that, and they are able to attract a lot of investors. Now, the family businesses, traditional businesses, a lot of these businesses have no idea what the business is valued for. And I'll start with giving you some point. A firm can value, and this is basic. A lot of people come to me and give me a lot of answers around valuation and try to make their own presumptions what valuation should be. I'll give you the starting point, and this is something which you should first of all note. The firm can have a value only if it ultimately delivers earnings. If the company, the business is going to eventually deliver earnings, and what the quantum of earnings is, that's where the value is really built. The intrinsic value of an asset is determined by the cash flows you expect that asset to generate over its life and how uncertain you feel about these cash flows. So fundamentally, you need to really see what do you expect from this asset and the life value of this to what it needs to generate and how much uncertainty it carries. If you bridge these two things, then only you come with a valuation. So valuation by nature, by structure is an art. It's not so much of science. I call it valuation is an art. It's not so much of science. While we have a lot of scientific and a very proven methodologies available by registered valuators, chart accountants, a lot of other consulting firms have a lot of methodology, and we'll talk about it. But still, this is still an art, and it's still not a science. So I will talk about how it becomes a structure. Now, another thing which is very important, that capital raise is no more a business, no more a choice, because the businesses are changed. They continue to ask for their growth. They need to have a reinvestment in their business, especially now the cycles have changed. You have to do a lot of innovation, a lot of re-engineering, a lot of new equipment you need to bring in, new packaging, new ways of selling. What was interesting to reach out to customer, like what happened in retail. If you see the retail environment, the first 10 years, everybody was putting a lot of capital in building these brick and mortar structures and so on and so forth. And suddenly they realize that they're losing on to the digital world, and they all have to invest into their digital capabilities. So their fresh capital was required. And now I know a lot of good companies, retail companies, which didn't have that money available, and they were not able to raise at the right time, and they were not able to sustain the change. And now the changes are becoming even more faster. So unless and until you have ability to constantly raise your capital, you will never be able to be ready to handle the changes which the environment would offer you, or the challenges the environment would offer you, or the competition would bring in, or disruptive ideas which would continue to come and hit the markets. And these disruptive ideas would force you to really bring in that. And if you're not adequately capitalized, you will not be able to cope up with that. And I can tell you a lot of traditional seasoned businesses which were running for decades are going out of businesses just because they've not able to unlock their value or their capital. So you can only unlock your equity. And this time, I think the greatest example we all are hearing these days is Reliance Industries. Reliance Industries, has chosen the path and shown the path to the entire corporate world that how important it is to really create a solid asset which can be valued, and how important is to continue to raise that value. Because now, so they have actually taken off debt out of their balance sheet and actually brought in a lot of equity partners. This is the way we should really look at businesses going forward. And I strongly recommend that small businesses, because we are a very large ecosystem of small to mid businesses. And every forum I say, debt is not good for these companies, because debt is cost of capital in business models like us. One, it would disturb your balance sheet forever. So cost of capital sitting in a balance sheet is not good for small and medium enterprises. They just run to pay the interest which keeps coming in the businesses. They're not able to take the business up. So always don't mind, even if it is your family run business, even if you inherited your business from your father, there should be no problem in unlocking your equity. So let's get into understanding of, there is no one set formula of putting a business valuation, but let's understand what are the few starting points, what needs to be done. First, whenever you're designing your valuation, see from the eyes of the investor. So calculated valuation doesn't mean unless and until investor and a buyer agrees with your assessment and past performance indicators. So unless and until the buyer or the investor is also able to see your assessment. And in the same way as you are able to see that assessment, and also your past performance indicators are also showing those benchmark, and then I can relate and validate those benchmark, then only I have something which is moving on. So always design your valuation from the eyes of the investor. Second, understand the valuation cycles. These are changing very fast. Why? Because our macro and micro dynamics change very fast. Economical changes, industry changes, competition has become very important and disruptive now. You don't know, there are visible competition and there are a lot of non-visible competition, which suddenly come to you, right? And these can be anything. It can be for any industry, for even Ola and Uber became a big competition for auto sales, right? They were invisible competition. You felt on one side there would be more cars on the road because Ola and Uber would come in. But the truth is that if people start using these shared vehicles, then they would not buy new cars. So fundamentally, sometimes we see the competition in a different perspective, and there is unseen competition which continues to hit you and a different structure. Like these days, this everybody saying television on demand or digital content on demand is a big, but it is also a big threat to multiplexes and your regular conventional channels and a lot of other things. So sometimes any disruption which is coming in can become a very strong part. So you need to do your valuation cycles in accordance to that. You need to see where you are and you need to adapt things of that nature. So I've seen a lot of businesses which get into fatigue and then they're not able to get into the right valuation. How you can keep your businesses relevant. And so I always insist that you do get your valuation done and almost every year, and then you will be able to do that. And also why it's so important that you need to really find out what is your business worth. And maybe we'll talk about this piece a little more in detail. And what is the reason why you should really have importance of finding out your business worth. I have realized that most of the times when the need really hits you hard, when like these times are very challenging times, very, very demanding times. And I'm getting calls from a lot of companies which are reaching out to us, especially our franchise companies and so forth. And they're coming and telling me, I want to really look at an exit. I'm looking for an investor. I'm looking for things of that nature. And when we look at their businesses were currently not designed to be rightly valued. Why I say so? Because they were running the business as they used to run. They never thought that they would have to make themselves ready for a future investor. So they never really brought some changes to really design the business that it becomes more attractive to investor. So look, please try to understand one single investor is always looking at 100 odd opportunities, right? Why your opportunity will shine out of that 100, that's very, very important. And unless and until you also mentally and organizationally prepare yourself for that right valuation, you will not be able to do the valuation right. I mean, you will not get the right valuation. Rather, people get shocked sometime when they get the valuation, and people like us, we go and say, you will not get that valuation. Recently, one of the technology companies we were evaluating, and we felt that there was nothing really about this company. This was just a simple CRM product, and there are multiple competitions available. Go-to-market was extremely tough. While being a technology product, young startup, the expectation of valuation is very, very, very different. And the revenues were sitting as only 30, 40, 50 lakh rupees as a business model. So we felt that this business has no real value, and why would somebody go in rather than putting some maybe 20 lakh rupees to build a similar or better platform. So fundamentally, you need to really see through and really get realistic on your business model, that how your business model is right. I always say that getting yourself valued can actually give you the biggest insight about your operations, and these are very important. I always say that people, because they don't get time, business owners don't get time to sit on their own balance sheet and put it in somebody else's perspective. And especially if you invite some independent evaluator or a business consultant who can value your business, and you will find a lot of indications in your business which will tell you how you need to fix those things in your operations. It can be your brand valuation itself. Let's see, brand valuation is a one topic. How much you're spending on brand valuation. What is your cost of acquisition of a customer? Is it sustainable? Is it going to reduce as we go along? Because now your brand would become more popular. Would it make sense that the early years you are spending more, but in 3 to 4 years, would this come down? what is their inherent brand value which needs to be done, or what are you chasing as a value? Because sometimes we get in love with our brand and we start spending too much in marketing. I also did this big mistake in our company, and we went on, I would call it berserk in terms of our spend in marketing. But now I'm realizing that there was a lot of audience we already built. Our focus should have been engaging rather than just doing more propaganda marketing. So sometimes you're doing things, but you don't see from a balance sheet viewpoint, you don't see from a future of a business viewpoint, and businesses and emotions have to disconnect. Somewhere you need to see business in the full light of business. So you need to really see what is happening on your brand. You need to see what is happening on a lot of other things happening in your businesses. And especially one of the areas which I've realized in, especially in retail kind of a companies or manufacturing companies, they see inventories as stock, as lying an asset in their books. While it is fine, but I feel that do you have too much of money being locked in as your inventories or non-performing assets? I know a lot of companies which would say I have 10 crores of stock, and if I go deeper into the business and find out that 5 crore is not moving, this will never move, but it continues to show you on a balance sheet. You continue to make you happy that you have 10 crores of stock. I know one big jewelry company used to claim that I have 1,000 crores of jewelry, but when the audits were really deep down done, they found that it was only 300 odd crores, and 700 was just pulled up, and this was not working. It was destroyed, and a lot of stuff was. So it's in especially in the diamond and the silver jewelry, a lot of damages were there. But in a book value, it was still showing you a very big value, and this creates a little bit of a memory effect in and businesses and business owners, that they start believing that this is a good asset sitting on that. While to me, this has to be checked. So you need to really go and check what is your asset side, what is non-performing, is how much inventories are real good inventories, and so on and so forth. And also then you need to do your micro analysis of numbers, your HR cost, your occupancy cost. These days, everybody has realized there's this unwanted offices and large infrastructures which created no real value to your balance sheet, was not to be done. Maybe even a company like TCS has said that they want to move 70% of the people work from home, not so much from security viewpoint, because 3 years from now, this virus would have gone. But TCS found that this was not wanted. And if they can invest more into data security and give that same promise to people to work out of their home, the 70% of this infrastructure which they've deployed, and they have millions and millions of square feet under management, which is a lot of cost and expense on their balance sheet. If they can correct that, this can empower their people better. They can hire better kind of people because they can pay them well, they can give them more value, and they will be more happy to contribute back to the system. So it will all change. So these are all important areas which, whenever you are valuing yourself, you need to really find that how you bring business efficiencies in your company, and these business efficiencies should reflect in your value. So one of the areas I always say is one who knows price of everything but value of nothing. So one means whenever you run a business, you have price for everything. I invested so much in my office, I invested this much in my computer, I invested some, but you need to understand what value it is bringing to your business. What is the value which it is providing you? So unless and until it is adding up, summing up in the value, it has no meaning. It has no meaning. It's just depreciated asset lying in your systems, which you continue to carry as business owners and feel happy about it. So, and we'll talk about how do you really do this structure. Now let's get into the business valuation side and how to value your businesses. One of the areas which surprises me that, people, especially young people who come out of colleges, and we have many in business X coming and doing valuations, they sometimes come with ridiculous numbers, right? They come with some numbers which I look at it, they would take a startup and value it for 40 crores, 50 crores. And this is just maths up. It's a maths up structure. And I'll explain you how. So valuations are always quantitative. When I say quantitative, which means it's a number game, right? So I would say next year I will have so much more revenue, I will have so much of better margin, I will have so much of this, so much of that. So, and I'll do 30% year-on-year growth, and I will continue to do for 10 years. And then I discount my sales at a certain level 4 to 5 years from now, and I will come down to discounted cash flow and then say, this is my valuation of the business. This is very simple. This is a quantitative structure of adding up things, right? It is adding up from X to that level. While this is the way valuation should be done, there's no argument in that. But here the valuation itself becomes an objective. I'll tell you how. most of the valuation people keep an objective in mind that I should be valued at 40 crores, and they sum up all this to become 40 crores. This is the maths which disturbs me, because I feel that fundamentally they just sum up something. There is sometimes no back history. Your last 2 years, 3 years performances have only been 10% or a negative growth, and next 3 years you want to show that you will do 25, 30, 40, 50%, in some cases 100% growth. How this is going to be possible, right? While as the companies become little, first 2-3 years have passed and the company's gone down to a little bit of maturity cycle, the growth rather becomes even more difficult to achieve. That's an argument, right? So bringing growth is not easy then, because you already done your honeymoon period, and honeymoon periods are always easy for the first 2-3 years. You can actually grow very, very fast. Everybody grows very fast. Every startup grows very fast. But after 3 years, 4 years, your growth actually declines. And that is the time you are actually reaching out to investor and telling him that, look, I will grow at 30% or 40%. How this is going to be done? And then the functional is that you will create some kind of a matrix to show those numbers, but these would not add up. This objective is very clearly already set that you have a valuation in mind. And there will be always uncertainty in numbers, as they will never predict the company's real performance and economy as large. Because economy will also change. You might predict your numbers, but economy has a different indication, right? Like these days, we will have a negative growth. If you have negative growth, on the other side, you are showing your growth very high. It's not collaborating. It's never going to collaborate. So before you go into detail down valuation, you need to really understand a few things on your balance sheet. You need to understand your tangible assets, which are still actively adding value to your balance sheet and adding value to your business. So tangible assets can be anything, which is property, machinery, inventory, any kind of asset which is available in your system can become a tangible asset. Intangible assets can be a lot of things, which can be your recognitions, trademarks, your so to say brand value, the kind of investment you've done in building the brand, and your patents and so on and so forth. So all that becomes your intangible value. Then you also need to very carefully understand your liability side. How much is a liability sitting on your balance sheet? What are these liabilities, which are softer loans, other loans which you have carrying on the entire thing, or you have to pay some vendors payments are standing, payouts, other payouts have to pending, some statutory payments have to, anything which is running on this everything. You need to create your overall financial matrix. What is your financial matrix looks like, and where do you really see in changing few things on your liability to asset size changing, how you can really define overall profitability and performance of the business. So I, over the years, have found a very simple method of finding a structure of valuation. I call it SAS principle, SAS principle. Now this SAS principle is very simple. Every time a business is presented to me for valuation, I always look at, while I would tell my financial guys to do the financial part of it, business, but I always look at from this SAS principle. I always look at business that what is the first S stands for the subscriber value. What is the lifetime subscriber value in this business? Which means that what is this customer base? How this customer is going to continue to make purchase decision with this asset for the next 3 years, 5 years, 10 years, 15 years? What is the lifetime value of that subscriber? And if there is no subscriber, it means that you're acquiring almost every time a new customer. It disturbs me. I don't see the business from a subscription value viewpoint. So businesses should have a strong subscription value. If you're acquiring almost every time a new customer in your business, then I will not give the marks on this S. This S, I will take it out. I'll say this has no subscriber value. You pretty much have to acquire every time a new customer. But almost every businesses I would know would have some form of subscription value. They would have people buying them, but only few businesses which have not so much of subscribers being built in. I feel that this S is missing. So the second S, A stands for clearly assets, your fixed assets, your current assets, your investments, and your intangible assets. So all kind of assets which are available, your fixed assets which you already deployed as an investment in the capex, your current assets, which means that you have whatever the current assets, your money lying in the bank and things of that nature, which is your current liquidity, and your your overall investments. If as a business you've gone and invested, made it investment in some properties, some other businesses or mutual funds or any other financial investments you've done, and your intangible assets. So we will bundle these assets and look at from a depreciation of some of the assets and come out of the value. And third is what I call the strategic value. Strategic value is also very important because it gives me a lot of understanding of why this asset is important. So a lot of time that we've sold, especially in the retail side, we sell businesses because there was a fantastic location you wanted to acquire, or there was a go-to-market capability. So you always wanted to get into market and you wanted that spot, and you will never get it. I give this example, like in Bangalore, almost every bar used to have a good value because the licenses were not available. So if you wanted to get into a bar business in Bangalore, you have to acquire something. So there was a very clearly value of that license in there. What is the strategic value in that business model? So we look at SaaS from three perspectives: subscription value, asset value, and a strategic value. Sometimes in assets, you have all three. Sometimes you have two. Sometimes you have only one. And whatever that is, you will take the business to the next level. Now, look at the cycles of stages of valuation. When you look at a very early stage company which have no historic data performance and so on and so forth, so obviously it carries a lot of risk in predictability of that business model. So how do you really show that predictability to an investor that this business in the next 3 to 5 years looks promising? And unless and until there is a very strong technology innovation, or this normally early stage businesses run on two basic foundations to me. I always value them from two foundations. One, what is a real valuation? What is a real ask they are trying to deliver? And second is, who's the founder? Founder has to have a huge credibility. He actually carries the sometimes 60% of the valuation only on his own shoulders. That's normally on the startup kind of a companies. Then you have a mid-size companies which have some performance already been done, but they've come down to a little bit of growth trajectory. And at a growth trajectory, they need to really change the orbit and they need more capital to come in. So they need differently. And when the large companies come in, that's much easier to value because these companies have a very historic data which tells you how they're going to do. So we need to ask a few questions before we really go into valuation of any businesses. We say, how predictable is your future cash flows? If somebody is able to show predictability in some kind of book size and say, this is what my business is going to look like, I like those businesses. How do you improve your margins, hence profitability going forward? One of the areas which I feel that margins actually become more tighter as your businesses grow and you have more cost coming in, you have inflation hitting you, your margins rather shrink. If somebody really demonstrates to me that, look, I have a method to improve my margin. And sometimes the margins are not just a basic maths of saying, oh, because I will have economy of scale, I will scale it up more, my margins would improve. That's a dumb call, right? Because these are very small shifts you were able to do, very, very small marginal differences you're able to do. And your inflation is anyway going in India very, very high. So eventually that call is actually almost every time failed. We've seen a lot of private equity companies investing into businesses which actually made commitments that I will, because of economies of scale, I will be able to improve margins. The example is that they have not been able to do. The clear fact is that economies of scale alone cannot handle your operations margins. You need to do something very radical to improve your margin and profitability. How would you sustain and stabilize your performance? This is another very important that stability in businesses are very important. Sometimes I've seen good businesses not so great or not so good now because they lacked few things. They lost some customers for something. They lost their key teams. They lost something else happening in them. I think the stability of the business is very, very important, and sustainability of that. What is your founding team? Who's your key guys? Who are the bankable resources would always be remaining there? Who's your competition inside and outside? Sometimes you have bigger inside problem. There are companies now which are actually started by the CEOs of the same company, right? So they've become competition to them. I think they take the talent. They take in financial services. This was a big problem. Financial services, almost all companies came from another company, right? So they know the game very well, and they were able to quickly shift the entire business to the entire thing. So there is a lot of inherent risk these days in technology, IP businesses, that there is a competition which is really coming from inside. And so how do you really control that? And how you're controlling that problem with the inside and outside also? And what is their influences and what is the larger threat to businesses? So this is how business is done. Another area which is very important for everybody to understand: when an investor invests into businesses, he doesn't look for so much of dividends. Please take it that out in the market. They look at more from their equity performance, which means that how, if I invested at an X valuation, is this valuation going to go up over the next 3 to 5 years? And second, am I able to find my exit at a particular time which is forecasted by me? So which means that if I say I will invest into this asset, next 3 to 4 years, I have predictability of my equity growing. Second, in 3 to 5 years, there is a mechanism been built that I will be able to exit that business. No investor gets into business to stay there. While they claim that I'm a long-term, always invested kind of investors, but very few investors I know would go into business without having a very clear predictability of exit in given time. Now, other few things which business owners do a lot of mistakes. They don't understand the difference between the asset value and the overall business value. Most of the times I ask people, what is the value of your business? They would say, oh, I invested so much, I have so much lying, and I have this inventory, and I have this asset, and I have my own office, and I have... So things of that nature. They just start counting their chairs and tables and computers and a lot of those things, and they don't understand the value of the business. And I can give you the golden rule. The only thing which matters to businesses and value of businesses is profit. Everything is around it. So, and profit is the life journey of a business. Life journey, which means you might not be profitable today. That's all right. But 3 years from now, 4 years from now, how can you show or demonstrate a very large profitability of the business model? If you're not able to show that profitability very, very clearly to investors, they don't like your business. That's out and clear. So don't try to show. They're not impressed with what you've invested. Nobody is trying to impress you with what I've invested. Rather, they see this all as a waste, because you deployed monies in depreciable assets, which are all going to depreciate eventually, right? They're buying into a balance sheet, and balance sheet would find a depreciated asset. You might still have physically assets available, but they've all depreciated in the balance sheet, right? So so how do you really show your net profitability of the business model? And then on profitability, you would need to then concentrate on what kind of multiples you can get on that profitability. And a lot of people come and talk to me and say, what is the top line multiple and things like that. I always look at the bottom line multiples. And even if you don't have now, that's okay. You can demonstrate it next year, next to next year, next to next year. Whenever you do this profit indication, that's where the valuation really has to be hit. If you tell the investor that, look, 3rd year from now, I will have a strong EBITDA, and that becomes your position of multiple. And then you can ask for a multiples. If you're a relatively smaller company and a relatively early stage company, this can go from maybe 2 to 10 anywhere, depending on which industry you are, how your performance has been, what is the competition, how crowded the market is, and So a lot of other things can come in. But if you are a much mature company, market leadership, category creator, a couple of other things, then your multiples can go even beyond 10. It can go up to 14, 15, 16. In very, very unique cases, we have found that multiples can go 20 and even above that. And so that's how the multiples would really. So first, you really have to understand what is your most performing year and your profitability for that year. That's the year where you would get the best valuation from anybody who's valuing your business at that stage. And you need to also see what is the structure. And also, you need to really see what is your industry telling you. Have you researched the industry? What is the other players in the industry, how they've been valued in the industry? That's very important. And why they were valued, what they had, which is better or bigger than you have. And that also has to be realistically done. Sometimes the market is not that big, so not everybody gets valued. There's only 1 or 2 early players get value, and rest everybody is just copying them because, oh, that guy got valued, I will also get valued. Look at what is happening on Ola. Now there was Uber, which is a global company, then there is Ola. Between these 2 companies, they're doing the entire fulfillment. You're not facing the shortage of cabs, you're not facing anything. Now, a lot of other players are trying to come in the same space, with trying to understand that they might get valued like Ola and Uber. Actually, is absolutely waste of money and effort. Unless and until you have either a very big shift of customer, and the reason for that shift, which means people would stop using Ola and start using you. Unless and until there is a big shift of that customer happening with the entire thing, I don't see there is inherent value. So you might deploy any kind of money, unless and until you have ability, and you should not have a mindset like we used to have in License Raj. In license Raj, you used to have a license, and once you get a license, you also have a right to get market share. Like telecom companies, they will give 2 more licenses, and these companies would also come and also get some market share. When you are in open market, consumers are very clear that they want the best. They don't want the second, third, fourth, fifth best, right? So don't try to do that. This whole license Raj has gone finished. It's not that you get a cement license. Now I can also manufacture a license and you will build a value in the business. This is an open world now. Unless and until you have a very strong competitive edge, you will not be able to deliver value. So research on your industry, understand your health of your business from a financial history. If it has not been good, at least it takes 18 months to 2 years to restructure your company. So a lot of restructuring has to be done in your business model, how you want to do that. There is never a late situation, never a late. Even if you are a 30-year-old company, 40-year-old company, you can give yourself a year and a half or 2 years and say, let's restructure this company. And restructuring might call for a lot of radical answers to be done, a lot of changes to be brought in, a lot of the way you want to look at businesses, how you can become, this asset light and OPEX light, and how you will build better performances in business. A lot of changes in your talent management, organizational structure, everything can be done, and you can bring in a better health of the company. And if you're able to demonstrate that change cycle in your businesses, you again refresh yourself and you're ready for a better valuation. And another thing which business owners have to also see, that some businesses are extremely dependent on the entrepreneur himself. So one of the reasons I see a business is not able to sell, and one of my companies was not, we took the business, an investor wanted to buy, and he asked me the same question. And he says, this business is totally dependent on you. And if you're not there, this business would not really be running. And while I did my own convincing, but he was very damn sure that I was very deep rooted in that business. And he felt that this business, because it's running because of you, and if you are trying to leave this company or you would like to depart from this company, this business would not remain same. So fundamentally, you need to understand that if you are so integral to your business and you cannot leave this business, or business would have a deep impact where you're leaving out, what plan you are making or what succession you are making, that this change happens and the business becomes radically able to handle. While they all love founders, but they also get threatened by founders. Founders become too close to their businesses, they don't leave the businesses that easy. And now these days we're seeing that companies find it a full cycle. There was Bunsel's had 10-year cycle with Flipkart, growing it, building it up, valuing it, and exiting it. And the Flipkart is still running. So, but this was very clearly planned. This was a very planned structure to get them exit, because eventually if you want to create a larger enterprise or institution, this would need to churn that. Fortunately, in India, we have succession plans coming from family and so on and so forth. But if you want to completely exit the business, one of the areas we need to do is that you need to find out, is your business, can run without you. Now, what is the right time for valuing your business? What is a good time you should look at valuing business? One, you have peaked out. So one of the reasons I always say, when you want to exit the business or you want to do that, because you peaked out. You did whatever you want to do that. You have getting no answers from anywhere, no book you're reading, no strategy attending, a seminar you're attending, you getting any idea to grow your business. This time has come, find a buyer. And that's what Business X does. Business X actually finds you buyers if you want to sell your business. So you have peaked out. Second, you see that there is an orbit change and it needs fresh capital. And you clearly see that there is a bigger audience available, but you need a bigger capital, right? If you want to catch that orbit, you need to reinvest business. And that either you don't want to reinvest your family wealth again in the business, or you don't have that money to invest, because this would need a new churn cycle, right? Like Reliance Retail is just about 15 years old. And now they're getting into a fresh cycle of investment because of the GeoMart and the technology and everything else. And everything else in the past they've invested might become redundant, right? So they are coming with a fresh cycle of investment. And I know other company I don't want to mention, which is the competition, doesn't have that capital. So what would they do? They have to exit. They have to exit because they don't have that capital. Because like in telecom, Reliance is ready for 5G and other companies have no money to even sustain 4G. They have no idea to get 5G. And if 5G hits by Reliance, everybody customer would ask for it. And if they don't have capital to do it, they would end up. So what they need to do, either raise or exit and find another buyer who's much more credible and much more bigger. And they would need to do that. Also, another thing, which is the opportunist way of looking at valuation, which a lot of people are able to do. There is an early sign of consolidation in any industry. Any industry gets into early sign of consolidation. This is exactly a good time where you should jump on it, where you should ask for a valuation for your business. I've always found that people who got the best valuation, when this co-working thing started, the first 4, 5, 6 companies which came in the market all got valuation, because there's early sign of consolidation, the early sign of the industry, and there was a and there is some kind of a early stage advantage. Never miss that boat. Never. Some people get into this whole cycle. No, I will like to value myself going 1 year from now or 2 years from now. Let me build more, and I don't need the capital at this stage, or I don't want to disinvest at this stage, or things of that nature. They miss the boat. They miss the boat because this is a very another area which you should always see. Never fight the elephant, right? So anytime you start a business, you're great, you're doing well, and you suddenly start seeing an elephant coming through, which means a large company is already entered that market. Always be very sure that you want to collaborate at this stage. Just knock the door of that company and say, you're inventing this, I've already done this, I'm already ready with this. It might give you a much faster go-to-market strategy rather than going and creating it yourself. And this would create a lot of merit. I know at an early stage, whenever large companies start looking at a category, they always look at evaluating businesses which are already there in the market. It gives them a lot of market understanding. They save very expensive, corporate has a very expensive mistakes which they don't want to do, because corporate mistakes are not like small business mistakes. They end up losing a lot of money because their resources are expensive, their structures are expensive, and it also can create a lot of setback for the reputation of their corporate. So they always goes with a bit of a caution. They don't mind putting a top dollar to get their learning in the system. And I know a lot of corporates, I can give you examples, which actually bought over businesses, brought these businesses in their system, and then made them redundant, right? Just because they wanted to get the learning out of that business inside them. Right? And sometimes you are able to redundant. Sometimes the business is such inherently rooted in the system, like Coca-Cola acquired Thumbs Up to kill Thumbs Up and kill other brands and bring Coca-Cola up. But they later realized that this was too rooted in this business and they cannot do it. It's still a quality asset when they started running that parallelly. But there are many examples which these companies acquired and they left it. And they took the learnings, they took the whole IP around it. And these IPs were so important to them that they never wanted to look back or do this again. So another area which is how expandable your consumer base is. This is also very important aspect of valuation, because sometimes you have built a very large consumer base, but you're selling very tiny product line to them. And if you can show the unlocking of the same consumer base, this consumer base can go wider. Some people have. I see small companies, they would come and say, I have 1 million people with me in my data bank, and they consume from me. And so such a large ecosystem they create, but they're not able to sweat out that ecosystem, right? That's also very strong inherent value creation structure. There's also a timing where you have built something extremely innovative, and this is a path breaking, like if you are doing anything in business intelligence, artificial intelligence, and things of that nature. These are all future. If you're doing anything in green energy and a lot of these things which are what I call sunshine sectors, that's also time where you will be able to do a lot of valuation. So this is covers my perspective of what kind of evaluation you need to do. I'll also touch upon 2 points. Whenever you are looking for valuing businesses, if you're a non-performing asset at this stage, which means that you're not making money, or you don't see, especially in these times, you don't see that your business is going to perform in 4, 5, 6 months, 7 months, 1 year, and you don't see yourself, and this is my genuine advice to business owners, that you're not ready for 1 year more investment in the business that you can sustain. Be absolutely honest right away, right today itself. Don't even wait for Monday. Start going in the market and asking for a right buyer. You might get it. If you delay this cycle, you might erode the value of the asset completely. So one of the companies called me, is in business which is badly affected in these times, and asked him a question. He says, I can still pay for 2-3 months of my bills, my salaries, and that thing. I said, do you think it's going to change everything in 2-3 months? And if you feel that this is not, and we all know this is not, then why don't we take decision right now? Why you want to be emotional about it? Take the decision to exit the business right now, and be fair that you will not get the what you ask for it. The market will decide what you are worth today, and go with the market and take whatever you get from this today. Sometimes I've seen a lot of deals gone crashed because the expectations were unrealistic on both sides. And at this time, this is a buyer market, right? This is not a seller market. So you have to go with the market. At this stage, you need to understand what market is telling you. So if you're a non-performing asset, normally your buyer is somebody who's more strategic, somebody who can turn around your asset and can make it profitable, right? It can be your somebody seeing a forward integration, backward integration, somebody is a value addition to the business, or something which you miss in your business currently. To turn around that business, he can bring that fix. He can bring that fix. He knows that he can bring that fix, but he's also taking a risk of going into an asset which is non-performing. So it's always been strategic. 70% of buyers would become strategic, and only 30% financial investors. But if you are a performing asset, then your 70% of buyer is financial and 30% is strategic. So first place yourself where you are, where you want to be, and structure. So this was I wanted to share 45 minutes. I've already done 7 minutes over. We started about 5 minutes late. So this is today's topic was valuation. BusinessX is a platform of Franchise India, which helps companies to find their value. And then we could also help them in terms of either raising equity or selling the asset. This is what we do at BusinessX. If you have any need on any help you require, or even want to understand further down in terms of what you should do in your call for raising equity or selling your business or something like that. And these days there should be no harm in be open, that if you want to really go out of this business, and that I think is changing very fast. And this has helped last 5-6 years when people were open about talking about there, because they should not wait for this bigger damage to happen. And if you cannot openly talk, you are actually already started doing a damage to your business. So thank you very much. I hope that I gave you some insights, and hopefully you liked some of the parts of this. All 3 series are available: Invest, Scale, and Value. Next week, we again start the same series. We'll add a few topics, and we continue to add. Like in valuation, I'll go deeper into some more detail on the valuation side, and on invest side, we'll take some case studies. In scale also, we'll take some case studies. We'll continue to work on this, continue to enhance the knowledge of our subscribers, people who have trusted Franchise India. So thank you very much. Sonali, over to you, please.
Thank you so much for the wonderful session, sir. It was absolutely great, as always, listening to you and your wonderful insights. We have a few questions lined up with us. I know we are running short of time, but would it be fine if we take a few questions at the end now? Sure. So the first question that we have is from Mr. Manish Behra. He says, on what parameters should freelancers focus on to value their business? They must be working independently.
So this is very tricky, Manish, in terms of freelancers. What kind of business you are in? Are you in consulting, or you building the business? And again, the problem would lie that if you are a freelancer, the business is around you, and if you're raising capital because you feel that something which you incubated is good and now it can be scaled and you need capital for that. Another reason which is very important sometimes, I have seen people raising money without even defining why they want to raise. So unless and until you go deep down and say, Manish, and say where you need this capital, what would capital do? Capital needs to sweat out. Where are you going to deploy that? If your business is freelance and its micro business is more, depend on you itself, where is this money going to go? And if you have a very clear and firm idea which can create shareholder value, then obviously you can raise. Anybody can raise money. Any good idea can raise money. That's not a problem.
Okay. So the next question is from Mr. Selva Ganesh. He says, as a franchisee, what should be the profit before tax to look for in FMCG? I understand early years may not be paying enough, but what could be the average?
This is more franchise ROI business, is not more for valuation, but average franchisee returns, what we call the the return on investment ranges from anything which is 20% to 25% in FMCG kind of business, which means 3 to 4 years it would take you to 4 years, or it would take you to get return on capital. It's a low margin business. FMCG is a low margin business, and I can go answer this even more specific. Sometimes I shy away giving these numbers because I don't know the brand and the business of model or anything which is discussed, and just throwing numbers is not a good idea. Uh, it can be better performance also depending on what business model it is and what margins. It's an integrated player or it's just a trading company. So it depends on which position it is. If you're an integrated player, you obviously have better margins, hence better profitability, better returns. But if you are a trader, then you're just trading, then you have only a trading margin. So it all depends on that. So
So our next question is from Mr. Sriram. He says, in case of e-commerce companies, they are accumulating losses year after year for several years, but they still are able to attract huge funding continuously during various periods. In these cases, did the priority of profitability change?
no. If you misunderstood my statement. Valuation would always be done on the profitability, but I have never said to you that the profitability would come in the first year, second year, third year, right? So while there is a larger goal to eventually hit profitability, and that's the end shareholder value. Like in older years, I don't know how much of you would follow, but I bought a shares for a company called Jindal Vijayanagar Steel, and it was a pre-launch offer, and it took 6 years for the plant to get set up, and 6 years the plant started functioning, and then plant started selling, and then the company became profitable. And we invested in 6 years back when the plant construction was to start, right? Those time IPOs were like that. So shareholder also is like that. Shareholder understands that when you're investing in a company, this has a 10-year, 15-year horizon, but he knows the horizon. He knows he can see the end of the tunnel. Where is the tunnel going? And every stage of benchmark, which means that year 2020 to year 2021 is your valuation, and your subscriber based, and your performance on balance sheet is improving. Are your margins improving? Are your acquisition cycles improving? Are your consumer base increasing? So all that is increasing, and your valuation is increasing. By the time as an investor I see my valuation either intact or growing, I'm happy with the company. And that's what happens with these young startups. When they raise capital, they put this whole projection, and anytime they are not able to fulfill that projection, things start changing. The shareholder is very worried, and they push these investors, and sometimes that's why these mistakes also start happening, because the founder gets into this whole worry to really cover up the balance sheet and try to get into businesses which is not there. I mean, some companies have become confused. Like look at OLX, started for what, known for what, doing what. So this is all because the shareholders are after their life, and they want, now they have already parked for 6 years, 7 years. They want returns and they want profitability, and they start selling everything. And this is what happened in a lot of startups, and that's where startups went wrong, because they are not able to they change their core business model because the business model was not more good. But I mean, these are closed door boardroom meetings where if you've done mistake, neither investors are going to agree, neither the founder is going to agree. What they're going to do is they're going to try to save that investment, and they want to try to save the investment means sell whatever needs to be done, get your balance sheet right. That's what people start doing, right?
Great. So I think we'll just take up the last question very quickly. So it is from Mr. Ajoy Khan. He says, other than investors, what kind of consultants can founders approach for selling stakes?
Sorry, I missed your question.
Other than just investors, what kind of consultants can founders approach for selling stakes?
You can go to any kind of consultant. Anybody who's your industry reference. You have investment bankers. There's so many investment bankers. Even Business X and Equity India is also a iBank. You can have industry consultants, reference points. Sometimes just pick up phone, and the buyer is. I mean, I always ask people, who should be your buyer, and they normally say, I know my competition, he can buy me. I say, just pick up phone and call him up. If you're not calling, I'll call you on behalf of you. So what should we worry in terms of reaching out if you genuinely feel that somebody is there? But if you need somebody to take up a full landscape for you, that who can be a buyer in your business, then obviously go and take a professional advice. Now there are certified evaluators. You can only get valuation from them, and they do the right valuation for you. Again, I said they do what they do is more, quantitative valuation. Sometimes as a business seller, even if your valuator comes and tells you you are worth 25 crores, you should not be happy about it. If you don't feel that you're not 25 crores, because you run the business, you know what your value should be, right? You can get a little bit of goodwill, but you cannot be unrealistic. If you become unrealistic, you will never get a buyer. So seller has to always understand and appreciate that you need to look from the buyer's eyes. And if you can see through and say, if I would have been in the same place, same time, I would have also paid the same price. If you can match that, that's the value of your business.
Wonderfully said, sir. So with this, I think we'll just wrap up the session. Thank you so much once again, sir. Thank you for a wonderful session. And we'll see you. It'll be a pleasure seeing you again next Saturday at 3 p.m. for another session of the series. Anything you would like to say in the end?
I said enough of 50 minutes is quite a bit of 50-minute listening. Me also is thank you to everyone, and thank you very much for having the patience to hear from us, and thank you from Franchise India and Business X. Thank you very much.